Hello everyone, welcome to the 50th episode of me learning how to trade in Forex. So in the last video we went through STP execution, which is straight through processing execution, how Forex brokers manage their risk. We made notes on all this page, found out what the difference between A-book and STP brokers are. So basically A-book confirms, sends your order confirmation and the third step, whereas in the third step for the straight through processing, they send the identical order to liquidity provider before confirming the order with the customer themselves. So that's STP. Made notes on all this, some very nice diagrams here. So A-book, straight through processing, and B-book execution. Learns about riskless principle. Basically they just make the profit back to back, or not make the profit back to back, do a back to back order. So trader buys from the broker, broker buys to liquidity provider sells to the broker, and then broker sells back to the trader. So it's like a loop basically. Done this, and then we're currently on internalization, how Forex brokers aggregate orders and hedge residual risk. So let's get started then. So below, what just happened? Why was it just like that? Okay, didn't like that. Below, so this is internalization, how Forex brokers aggregate orders and hedge residual risk. Date is the 18th/02. With A-book or straight through processing execution, the broker manages the risk of each trade individually. But what if one trader opens a long GBP/USD position and another trader opens a short GBP/USD position, or at or around the same time? Rather than the A-book broker having to hedge each trade separately with a liquidity provider, why can't the risk exposure from the two trades cancel each other out? Well, they can. Instead of managing risk for every individual trade, a broker can aggregate customer trades that all contain the same currency pair. This process of aggregating trade is known as internalization. So internalization, the process of aggregating customer trades that all contain the same currency pair. The process of aggregating customer trades that will contain the same currency pair. Wait, that's not really right. It's the process of aggregating customer trades that can all contain the same currency pair when managing risks. That's better. For example, some customers may buy GBP/USD whilst others may sell GBP/USD. The different traders have different opinions, so there may be instances where opposing trades can be matched or offset with each other. When a broker matches one customer's trade with another customer's, it removes the market risk in a similar manner to hedging the trade with an external liquidity provider. Because the broker does not send the trades to a liquidity provider, it saves money by not having to transact with a liquidity provider and pay the liquidity provider's spread. A broker can aggregate all long and short GBP/USD positions and offset them against each other. This is why Forex brokers want a large customer base. It makes it easier for them to internalize risk. The larger their customer base, the more trades that occur, which means the higher the likelihood that trades can be offset with each other. Since it costs money to trade with liquidity providers due to the spreads, this helps a broker save money. For example, the broker can see in its book that it has a total of 10 million units of long GBP/USD and 8 million units of short GBP/USD positions. So 10 mil minus 8 mil equals net 2 mil. long. The difference would leave the broker with a net long 2 mil GBP USD position. This difference is also known as the residual, since it's what remains after all the trades are offset. What remains exposes the broker to market risk, which is why it's called residual risk. So residual risk, which is the difference between the short and long positions for a currency pair. The difference between the short and long positions for a currency pair the market risk stemming from the difference between the short and long positions for a currency pair. Yeah, okay, that sounds about right. What remains is called residual risk. Yep. The broker now has to decide how to manage this residual risk. It has two choices: accept the risk, do nothing; transfer the risk, hedge; or basically trading with the liquidity provider. Example: A book execution versus internalization, full offset. Elsa buys and Ariel sells at the same time of the same currency pair, GBP USD, at the same time. Under this scenario, the broker prefers to transfer its market risk to its liquidity provider. The liquidity provider's prices are marked up by 0.0011 or 1 pip. Let's see the difference between A book execution and internalization. So, rip Ariel, because now we're replaced with Eric. So, sell, buy 1 GBP from this broker, sells it to Elsa, does the same trade, so buys it from the LP, liquidity provider, sell, buy, does the same, sell, buy. So that's A book, if it's done in A book way. Internalization, buy, sell, yep. Sell, but this one, the amounts are different though, isn't it? Because that's 3 mil and this is... Wait, that's 300,000 actually. Why is it done? That's weird. Okay, 300,000, but this is 100,000, so the number's different here. Oh, this is just an example of how, right, it cancels switches it out basically. If the broker exercised A book execution, it paid for the spread of liquidity provider, and the broker's profit and loss versus liquidity provider would equal. So 1.2007 minus 1.2010 times 10, 1 mil, but that's 100,000 though, so that's some typo here. Minus 300 USD. If the broker took advantage of the fact that the trades happened at the same time and didn't hedge with a liquidity provider, then it wouldn't have paid that cost. The primary risk for a broker operating the internalization model occurs when positions are not completely offset, leaving the broker with exposure to price movements which could result in a loss. If a broker has a customer orders that can offset each other partially, then the broker is left with a much smaller net position that leaves the broker exposed to market risk. Again, this is known as residual risk. It can manage this residual risk in two ways. The broker can transfer this risk externally to a liquidity provider by executing a hedge trade. The broker can accept the risk and manage it internally. Isn't that what we just covered? Literally. Here. Right, okay. Example: A book execution versus internalization plus hedge order. Let's see the difference between A book execution and internalization followed by a hedge trade. So A book does the same 1 mil. Yep. Internalization plus hedge order. So 1 mil, sell. buy 3 mil, yep, sell 2 mil, because that's the leftovers from plus 3,000 minus 1,000, so that's 2,000, sell, buy. Okay, if the broker exercised daybook execution, then the broker's realized profit loss versus liquidity provider would equal minus 100 USD. But the broker didn't necessarily need to A-book Elsa's trades because Eric's trade could offset. So the broker had internalized or aggregated all GBPUSD positions. It wouldn't need to hedge Elsa's trade and would save money by not paying the liquidity spreads, providers spreads. Even after internalization, this still leaves the broker with a net short position of 2 million GBPUSD. As you can see, the broker hedged this residual risk with a liquidity provider. If there are enough trades of similar size to offset one another, internalization can be very profitable for a trader. That said, if positions remain that can't be offset, this residual risk exposes the broker to the same market risk as a B-book trade. A common practice when brokers internalize trade is to first offset customers' positions against each other, and then aggregate the remaining risk exposure and hedge externally with a liquidity provider based on a volume weight average price, or VWAP. Volume weight average price. So, Elsa, Ariel, Eric, Jasmine, Louise. So, 1 mil, 100,000, 100,000, these two offset. Sell 200, so sell 500, sell 8,000, sell 800, oh no, sell 1 mil actually. So selling 1 mil, and then if you buy 1 mil, that offsets it to 0, and then yep. From the example above, we can see that the Elsas, and also there's a markup, we can see a markup from here basically, so 1.512. From the example above, we can see that Elsa's trade was internally offset by Ariel's trade. Elsa went long 100,000 GBPUSD whilst Ariel went short 100,000 GBPUSD. So the broker's risk exposure is 0. But then 3 other traders, Eric, Jasmine and Louise, went long GBPUSD at different prices. With no other customers going short, the broker wants to hedge this risk. Instead of hedging each trade individually, the broker aggregates. So I think aggregates just means adds it all up, or the summation, the 3 separate trades, and creates just a single hedge trade from a liquidity provider based on a volume weight, volume weight average price of 1.2511. Here's how volume weight average price is calculated. So the volumes here, price, notional value, total notional volume divided total volume, right, 1.2511. Aggregating multiple customer trades is a common practice for brokers since trading with most liquidity providers requires a minimum trade size, usually at least one standard lot or increments of 100,000 units. So for brokers, customers are opening positions smaller than 100,000 units, then the broker has to wait until other customers trade where it can then bundle the risk from different trades. Another reason that the broker may aggregate orders is that it reduces the time it takes to get all hedged with a liquidity provider. For example, if the broker is using straight-through processing execution, the execution of many small buy orders one at a time could signal to a liquidity provider that this pattern may continue. If it detects more orders interested in buying than selling, it can shade the price and raise the ask buy price higher than it normally would. This may result in the broker's customers getting worse fills than if the broker just sent one single order to the liquidity provider. This is particularly important in illiquid or fast-moving markets. I think this meant illiquid. What's illiquid? Non-liquid or liquid or fast-moving markets. Here's a summary of how a forex broker benefits depending on its execution method and the outcome of a trade. So, customers trade, they won the trade. Brokers order execution, B-book, accept risk. Benefit, customers gain is broker's loss. Customers win A book transfer, broker spread minus liquidity provider spread. Win internalize broker spread. Lose B book. Customers loses, brokers gain. If customers trades loses, doesn't matter, still the same. Loses, internalize, doesn't matter, it's still the same broker spread. Okay, fair enough. So next one. Why do Forex brokers B book? (1802-29). What is a B book broker? Remember, the B book broker is this. So there's no third party liquidity provider, so you're only trading against the broker themselves. When you open a trade with a B-book Forex broker, the broker takes the other side of your trade and does not hedge. The broker keeps the trade in-house. Remember, if your broker is taking the other side of your order and is not hedging, it's with a liquidity provider, it is taking 100% of the risk associated with your order. This means that if the customer's trade loses 1,000, the broker wins 1,000. But if the customer's trade wins 1,000, then the broker loses 1,000. Given that the broker can still lose, B-book execution seems risky. Why do brokers B-book and expose themselves to market risk and losing money? Because most retail traders lose. Oof. Think about it. Between 74 to 89% of retail accounts lose money when trading Forex. This means 74 to 89% of retail Forex traders are wrong. With customers like these, the broker sees as an equivalent of playing the game of heads or tails and betting heads with a coin that will land on heads 74 to 89% of the time. If you know you're going to be on the winning side at least 74% of the time, why wouldn't you take that bet? The odds will definitely be in your favour that you would win the bets. Now imagine that you're a Forex broker and you know that your customers are wrong over 70% of the time. Would you B-book? I'm sure you'd jump at the opportunity. That's even better odds than betting on black when playing roulette. If a broker wants to STP or A-book, it also has to pay a spread to a liquidity provider to hedge your trades. This means it costs them money to hedge. But why hedge if most customers are going to lose? Brokers B-book trades because it's usually more profitable for them. How B-book brokers make money. You buy from the broker and sell to the broker. If you make money, the broker loses money, and vice versa. This means that when you lose, the broker profits. And if all you do is keep losing, then the broker is slowly capturing more and more of the money that you initially deposited in your trading account. Retail traders tend to act like gamblers, and the B-book broker acts as the house. Most new retail traders have no trading experience, and it's not uncommon for 80 to 90% of them to lose their entire deposit within 12 months. Jesus. There's even a popular rule known as the 8-90-90-90 rule. This rule states that 90% of new traders lose 90% of their money in 90 days. We're not sure how accurate this rule is, but whether it's 90 days or 12 months, imagine being a B-book broker with these customers. All you have to do is sit back, relax, and wait for your customers to lose, then watch your profits start rolling in. To provide a simple example, here's how much money B-book broker makes over a year, assuming an average deposit of 1,000. So if you've got 100 customers, total deposit 100,000, percentage of deposit that customers lose after 12 months. And this is every year, isn't it? So 6,000. Jesus, 6 mil. Whilst an average deposit size of 1,000 might be considered small, as you can see, being a B-book broker can be extremely lucrative. It can even be more lucrative if broker gets their customer to deposit even larger amounts. Now, just because B-book brokers profit when their customers lose does not necessarily mean that they want their customers to lose. Yes, it does benefit the B-book broker if you lose, but all the hullabaloo about every B-book Forex broker is trading against you is either propaganda. Wait, yes, it does benefit the B-book broker if you lose, but all the hullabaloo about every B-book Forex broker is trading against you is either propaganda created by A-book brokers wanting to take market share, or traders who refuse to entertain the notion that they may actually be losing because they just suck at trading. If a broker has just one customer and uses B-book execution, then obviously it wouldn't want the trades that its only customer makes to win. That would mean the broker would be on the losing side every single time and would be running an unprofitable operation. So yes, in this specific scenario, the broker does want its sole customer to lose. However, brokers don't have just one customer, they have many. What B-book brokers really want is to pocket as the spreads and not to have to hedge, because hedging costs money. The problem is that since the broker takes the opposite side of their customers' trades, they are exposed to the risk of being on the losing side of the trades, and if they don't want to be exposed to this risk, they have to hedge, unless what B-book brokers like a large number of similarly sized customers. B-book brokers prefer to have a lot of similarly sized customers who trade as frequently as possible and open long and short positions in equal amounts, so the broker can take the opposite side of each of their trades. This allows the broker to pocket the spread on both sides without taking any market risk, because positions are netted out, offset each other. For example, a retail trader A wants to buy 10,000 units of GBP/USD, so the broker offers 1.4105 ask price. At the same time, retail trader B wants to sell 10,000 units of GBPUSD, so the broker offers 1.4103 bid price. So if the broker buys GBPUSD for 1.4103 from a retail trader B and sells GBPUSD for 1.4105 to retail trader A, pocketing 0.0002 or 2 pips from the spread. Since both orders are the same size, 10,000 units, they offset each other, which means the broker is not exposed to any market risk. The broker will love to do this a gazillion times a day. Love fishes but not whales. B-book brokers aren't fond of high rollers or whales. In gambling lingo, a high roller, also referred to as a whale, is a gambler who consistently wagers large amounts of money at a casino. Please take all my money. If you think of a B-book broker like a casino, it doesn't want a customer that trades so big that any individual bet exposes the broker to so much market risk that could cause it to go bust or take the house down. What B-book brokers prefer is that their customers trade in similar position sizes and trade frequently. For example, it would prefer to have 100 customers all trade on average 5 mini lots, then have 98 customers who trade 3 mini lots, and then have 2 whale customers who trade 20 standard lots at a time. This allows the broker to offset trades with each other rather than exposing itself to market risk. Also, this reduces the capital that a broker needs to set aside, which would be used to pay out winning trades, because the customers are essentially making a market for each other. What B-book broker love the most is when their customers are consistently trading and are not winning too much nor losing too much. The ideal scenario for a B-book broker is where half its customers open long positions and the other half open short positions, and that their customer trades these opposing views frequently. This would mean that all positions offset each other and the broker is not exposed to any market risk. So little capital is required by the broker, because any gains it would have to pay to winning traders could be paid with losses from the losing traders. The broker would just constantly make money from the spread and overnight financing charges and not have to worry about going bust. What B-book brokers don't like. B-book brokers don't necessarily like customers who win consistently. These customers will grow their account balance over time, allowing them to open bigger and bigger position sizes. Eventually, they become too big and risky for the broker that their orders have to be hedged, A-books. Remember, hedging costs money, and since the trade is now hedged, the broker won't make money if the customer loses anymore. So its revenue is now limited to pocketing the spread and overnight finance charges if the traders leave their positions open overnight. They also don't like traders who are too good, because the trader is taking away money from their other customers. A B-book broker prefers that those profits are passed around more evenly among its customers' base, since It allows them to continue pocketing the spread from a larger pool of traders. This is all fantastic news for brokers who run a B book, but it's not so fantastic for brokers that strictly run an A book. Every time an A book broker sees a losing customer, it is potential profit that is now lost forever. But not so strong A book. Every time an A book trader sees a losing customer, it's potential profit that is now lost forever. With such a high percentage of new traders blowing their accounts and a universe of new traders being finite, it is questionable if a strictly A book approach is sustainable in the long term. It's an extremely tough business for a retail forex broker to operate as 100% A book. It's hard to make a lot of money, and with margins so tight, it's not surprising why brokers running a B book as an B book as an additional source of revenue. That said, the B book model is considered challenging in terms of risk management, especially if you have lots of customers who open positions in the same direction and trade profitably. If their customers win big enough, the losses for the broker could be enough to put the broker out of business. This is the reason why most brokers use a combination of B book and A book execution, also known as a hybrid model. So. B book brokers like a large number of similarly sized customers who trade as frequently as possible and open long and short positions in equal amounts. Allowing the broker to pocket the spread on both sides without taking on any market risk. I'm fond of whales. Don't like whales, as they could as one winning trade could bring the house down. Also, don't like customers who win consistently. Most brokers use a combination of A book and B book execution, known as hybrid model. Cool. The hybrid model used by Forex brokers. The hybrid model used by Forex brokers to 2024. In the previous lesson we talked about why Forex brokers are attracted to B-book execution more than A-book execution, even though it's riskier because the broker can blow up if it doesn't know WTH is doing, what the heck is doing, and has poor risk management. But what if brokers could get the best of both worlds? So far we learned that when a broker executes your order, it can choose to fill the order. So before hedging A-book, by not hedging at all B-book, by internalize first and then choosing one of the above, by hedging first SDP. But a Forex broker is not limited to just one form of hedging. It can choose any of the above depending on the order and or customer. Right. How the broker determines who to choose for which model depends on different factors like trade size and a customer's profitability profile. Oh, so every customer's got their own profitability profile. A broker can generate independent price streams and hedging models for social traders, news traders, API traders, or screen traders. Damn. Before what was I gonna say? A broker is not limited to one form of hedging. It can choose any depending on the customer and or order. Through the trade size / customer's profitability profile. A broker can generate independent price streams and hedging models for social traders, news traders, API traders, or screen traders. Most brokers operate at least an A and B book, selecting which trades are internalized versus hedged with a liquidity provider. This is known as the hybrid model. While your Forex broker is always counterparty to your trades, a hybrid approach is where the broker may decide to execute your trades internally or offset your trades externally to a liquidity provider. A hybrid approach allows the broker to offset orders with other customers, hedge orders with an external counterparty, liquidity providers, or not hedge and accept full market risk. So, a hybrid approach allows the broker to offset orders with other customers, hedge orders with an external counterparty, or not hedge and accept the full market risk. Market risk is the risk of a loss in a position caused by adverse price movements. Learn more about the perils of the market risk here. Here are two examples of how broker operates when taking the hybrid approach. The broker can divide its customers and hedge the trades of some of the customers to a liquidity provider, A-book or STP, and keep the rest in-house. The broker can decide to hedge all trades of a certain size or larger to a liquidity provider and keep the rest in-house, B-book. So that's depending on its customers, and this is the order size. Customer profiling. In the hybrid model, the Forex broker has to decide which customers go to A-book and which go to B-book, and why. Once these rules and criteria are all set, the broker will have an order routing system or order execution engine, whose purpose is to manage orders by sending them to A-book or B-book automatically. The broker will most likely hold the trades of losing customers for themselves and hedge against the trades of profitable traders. So, broker will most likely hold the trades of losing traders for themselves and hedge against traders profitable traders. This means that successful traders will be A-booked, while small unprofitable traders will be B-booked, where the market risk is kept in-house. To successfully identify profitable and unprofitable traders, Forex brokers have software that analyze how customers trade. Damn. They can profile traders by the amount of their deposit, the notional value of each trade, the leverage used, the risk taken with each trade, the use or non-use of protective stops, etc. For example, there seems to be a common pattern of behavior among losing traders. These behaviors include depositing a tiny amount of cash, which means a tiny starting account balance, usually less than 1,000, risking 10% or more of their tiny account balance per trade, not using stop losses, adding to losing trades. Using high leverage on the tiny accounts makes them frequently susceptible to margin calls and stop outs. Right, so should not do this then, basically. To identify brokers use software which analyzes to identify profitable and unprofitable traders. It can profile traders by the amount of their deposit, the notional value of each trade, the leverage used, the risk taken with each trade, the use or non-use of protective stops, etc. For example, there seems to be a common pattern of behavior among losing traders. These behaviors include losing trader behaviors: depositing a tiny amount of cash, which means a tiny amount of starting balance, usually less than 1,000, risking 10% or more of their tiny accounts balance per trade, not using stop losses, adding to losing trades, using high leverage. With the use of computer algorithms, brokers are able to analyze trading patterns to profile the trades of each customer. Brokers can be different brokers to different customers. It can be a B-book broker to some and an A-book broker to others. The reason behind customer profiling are simple. The customers who are A-booked are more successful and will generally be trading in larger lot sizes. So fully offsetting these orders with an external counterparty eliminates exposure to market risk, while still earning a small fee from the spread. On the other hand, the customers who are B-booked will generally be smaller orders, mostly losing trades, and the broker can warehouse the market risk since the risk is small because the trade size is small. This allows the broker to profit from the losing trades from its B-book customers and also earn the price markup from its A-book customers. Right, I see. So best of both worlds, basically. Okay, large Forex brokers. For larger Forex brokers, because they have a large number of customers opening trades in both long and short directions, they're able to internalize a great deal of their order flow, which allows them to minimize their market risk without having to hedge with an external counterparty. When not all of the positions are able to be hedged, the excess market risk exposure is then hedged externally. A large customer base allows most large Forex brokers to theoretically offset most of their customers' trades with each other. This allows revenue to be earned from the customer's transaction fees, from the spread, which means that it is the volume of customer trading that drives revenue, not from the customer's losses. For smaller brokers, if they are unable to hedge their trade with another one of their customers, they B-book, take the other side of the trades, up to their market risk limit. Anything above this limit will be hedged externally. The use of B-book combined with only externally hedging beyond a certain risk limit provides a better order execution because it allows the broker to immediately execute a trade whilst keeping latency and its cost to a minimum, because it doesn't have to A-book or ST or straight through process every trade, which would mean paying the liquidity provider spread every time. Most Forex brokers use a hybrid approach. We don't see anything wrong with a broker operating both A-book and B-book. The reality is that most brokers do use a hybrid approach. The profits gained from the traders placed in the B-book allow the broker who use the hybrid approach to provide all their customers with very competitive spreads. The main disadvantage of this approach is that the broker manages the risk of B-book poorly. The broker could end up blowing up and going out of business. Trades from new retail traders will most likely be B-booked. This makes sense since most new traders lose. It's easy money for the broker. It's very rare for a retail Forex broker to be 100% A-book. It's a tough business model. The A-book model is a much lower margin business than the B-book and requires brokers to focus on customers who trade frequently in large quantities, while trying to keep costs as low as possible. With so many unprofitable traders, a B-book model provides an additional source of revenue. There is nothing wrong with a retail broker having a hybrid of both A-book and B-book. What is wrong is when a Forex broker starts to manipulating trades in its favour. The most important consideration for a retail broker, at least in a well-regulated jurisdiction, should be ensuring fair pricing and best order execution for their customers, regardless of whether it adopts an A or B-book model. Regardless of the broker's execution model, what's most important is that retail traders receive transparent prices that track the real institutional FX market in real time and be able to get their orders filled in at these prices or better without any delays. Note that it says quote real because, well, we're not actually trading in the institutional FX market, are we? We will discuss pricing and order execution quality in more detail in a later lesson, but first let's learn one more risk management approach that Forex brokers use. Okay, I'm going to leave this episode here. Thank you guys for watching. In the next video we're going to be carrying on with C-book, how Forex brokers manage their risk. So I'll see you then. Peace.